5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Well, friends, welcome to you all around the world. Welcome to the Follow the Money podcast. I'm Jerry Robinson, thrilled to have you here with me for today's episode number 480, and one that we are calling Straight Talk on Swing Trading. In fact, today is going to be a Q&A edition of our podcast, so we're really excited about that. We're going to take a practical deep dive into the world of swing trading, and if you've been with us before, welcome back. Great to have you here on the podcast. So if you're new, buckle up because we have a lot of ground to cover today. First things first, we're going to begin with that Q&A session that's been lined up for you, featuring questions from our platinum members, our gold members, our silver members here at followthemoney.com. These are traders, aspiring swing traders, experienced traders. They've been sending in their top swing trading questions. And what we've done is we've compiled several of them for today's broadcast. And they're going to cover everything from the best time frames for busy professionals when it comes to swing trading, whether it's that or managing risk in volatile markets, or how to decide whether to go short or go long, or trading sector ETFs, and on and on. So it's going to be lively. It's going to be a great overall session, I believe, and I can't wait to tackle each one of these questions. Now, after we wrap up our Q&A, we'll take a short break, and I want to highlight our brand new Swing Trading Simplified course that's available now on followthemoney.com if you haven't heard about it yet. This is an ongoing 10-module video program that we built to guide you step by step from core swing trading principles to advanced techniques and risk management. So it's something I'm genuinely proud of to share with our community, and I want to tell you more about it in just a bit. Then in segment 2, we'll switch gears for just a few moments and talk about the markets. I'll provide a little bit of a market update and commentary. We'll dig into some of the latest market trends, and I'll share some of my observations about what's been moving up, what's been going down, and perhaps why. And then finally in segment 3, we'll wrap things up with some concluding thoughts. And by the time we're done, I hope you'll have a clear blueprint for refining your own approach to swing trading. So stick around. We've got a lot to cover, and I'm glad you're here to be a part of it. Let's get started. All right, welcome back, friends. Welcome to our Q&A session where I'm going to be answering your swing trading questions straight from our platinum, gold, and silver members here at followthemoney.com. We've received some excellent questions that cover a broad range of topics, and my goal here is just to dig deep into each of these questions and share some practical tips, point you towards some of the best resources that we've compiled over the years. And if you sent one in, I want to say thank you. And if you're just tuning in to learn, buckle up, because this is where we really get down into the nitty-gritty in the details of swing trading. Now, I'm not going to go over swing trading and explain the whole thing. Now, we've certainly done, much larger podcasts just on the topic of swing trading or understanding it. But just so you know, it's just basically holding a stock for a period of a couple of weeks, sometimes up to a couple of weeks, and looking to earn a little bit of money from that trade. It's not day trading. It's not long-term investing. It's just trading a stock for a handful of days or a couple of weeks and looking to make money. But quite frankly, it's more difficult than it appears. It sounds pretty easy when you first hear about it, but it is challenging. I started swing trading, nearly 2 decades ago, and I've learned a lot over the years. And so that's the point of today's broadcast, is to share with you some of the things that I've learned through many of these listener questions we receive. So let's get started. I want to begin with a question that came in from a platinum member in Denver, Colorado named Danielle. Danielle is the one who sent it in. Danielle says, "Hey, Jerry, I'm relatively new to swing trading and I still have a full-time day job. Which time frame should I use for my charts? The daily or the 4-hour? Also, how can I stay on top of my trades if I can't watch the market all day?" So this is a great question from Danielle. And first off, I want to congratulate her for diving into swing trading while balancing a full-time day job. That's how I got started too. I was working a full-time job and I learned how to trade. Many traders start right there. It's absolutely doable. Now, the first step, Danielle, is to identify the right time frame. When you're asking about time frames, daily or 4-hour, you want to find the right one for your schedule. And typically swing traders, they tend to gravitate towards the daily chart because each candle reflects one full trading day. That really smooths out a lot of the intraday noise, and it allows you to check into the markets either before work or during a lunch break or in the evening, whenever you can kind of squeeze it in. And when you use the daily chart, it really helps you see clearer trend patterns and prevents you, I think, from micromanaging every single price fluctuation that can happen. A 4-hour chart I really like. It's really beneficial if you have more flexibility in your schedule because it allows you to catch more, potentially earlier signals. Let's just put it that. And you can fine tune your entries a bit more with that 4-hour chart. But again, if you're juggling a demanding job and you're constantly refreshing a 4-hour chart, that can be stressful. And we want to reduce your stress, not add to it. We don't want trading to be uber stressful for you. Otherwise, you're not going to be able to do it longer term. So when it comes to managing trades without watching the market all day, quite frankly, I like that. I don't like to sit in front of a screen all day long and look and micromanage my trades. When I'm swing trading, I prefer to have a bit more of a hands-off approach. But there's a few tactics that you can use when it comes, to not look at the charts all day long. One is just simply to set alerts with your brokerage platform or the charting service that you use. So if a price crosses a particular level, like a support or resistance that you're interested in, then you just get a notification. Another strategy is just to place a stop loss in advance. That way, your broker automatically executes your exit strategy if the market reaches your predefined levels and you're in a meeting at work or you're at lunch or whatever. You can also adopt a simple morning and evening routine. I think this is really a key for success in the morning. You can spend about 15 to 20 minutes reviewing any news around the stocks that you are holding or any overnight market moves that might affect your positions. And then just adjust your stops, your targets, if necessary. In the evening, you can do a more thorough check. You can see how your trades stand. You can analyze any new setups you might want to consider entering soon. You can also evaluate how the day's price action lines up with your broader plan. And also, you can do what I consider to be very powerful is just a weekly review. That's what I do. At the end of every week, I take a look and kind of take an inventory of what's been going on with my trading activity. If you don't have time to scrutinize every single candle every single day, well, make sure you do it on the weekend. Do a deep dive. Look at those weekly charts. Look at the daily charts. Look at the 4-hour charts. Evaluate all the different market trends from different time frames, and then update your watch list. And by doing that consistently, I think you'll keep your finger on the pulse of the market, even with that job and that you have. And then, of course, if you do that on the weekends, you'll be even better off. I think I also want to suggest to you, Danielle, that you would want to keep a trading journal, even if it's digital, even if you're just keeping it on your phone or on your computer. I'm kind of old school. I use an old, like an actual journal book. But you want to log your entries, your exits, write down your thoughts about each trade. It helps you see the patterns. And over time, I think you'll develop a sharper eye for which setups work best and which ones don't for your particular situation with your limited screen time that you have trading from work. So, I'd suggest starting with daily charts overall to keep things straightforward. Use the alerts, use some good stop loss orders to manage the trades. Carve out some specific times to review your positions as you can. And I think with some discipline and consistency, Danielle, you're going to find that swing trading can work even with a busy schedule. We have many members who do it, and congratulations to you for taking the initiative. All right, let's move on to our next question. This question comes from William from Raleigh, North Carolina. He is a gold member. He says, "Hey, Jerry, volatility has been throwing me off lately. Could you share some tips on managing risk when sudden news headlines or economic data cause big market swings? I'm trying to avoid panic moves, but still keep a decent stop loss. Welcome to the world of volatility, right? When you're a swing trader, volatility is that double-edged sword. On one hand, it gives you the price swings that you need for profits, right? But on the other hand, it can shake you out, cause unnecessary panic if you're not prepared. So the key is to have a risk management strategy, right? One that respects the current level of volatility, which you should know as a swing trader, but then also that accounts for those sudden news-driven spikes, which some sympathy for you, William, especially in this current environment where we have had so much whipsaw action with the introduction of a new presidential administration and all the things that go along with it. So it has been a little challenging. Let me give you some tips. First of all, I recommend sizing your positions according to the average true range, the ATR. That's one of my favorite indicators for determining the volatility of a particular stock, but also to help me determine my position size and my stop loss, right? So you can use the average true range. You can use another volatility measure. I just like the ATR. It gives you a sense of how much a stock typically moves in a given day or any particular time frame. If you look at it in a daily time frame, it'll show you the average move that the stock has typically in a single day. And if you see that the ATR has recently jumped significantly, then it might mean that you want to reduce your position size to keep your overall risk in check. For instance, if a stock's daily ATR goes from, say, 1 to 2, then effectively that doubles how much it could swing in a day, right? So you might consider having your shares to maintain the same risk profile. You might just, trade half of the shares. Secondly, you need to think real carefully about where you place that stop loss. So in a volatile market, obviously you've learned this, Robert, but placing those stop losses too close can get you stopped out, even on minor fluctuations, right? And then, of course, it's so frustrating to see the price snap right back after it stops you out. It almost seems like a conspiracy when it happens to you, but of course it's not. It's just the market. And one technique that I've found that's useful is to use a multiple of the ATR for your stop. So for example, if the ATR, the average true range, is 2, well, you might consider placing your stop at some multiple of that, somewhere between 1 and 2 multiples of that. That's one thing that I've certainly used over time. That ensures the trade has what we say enough room to breathe. You mentioned wanting to avoid some panic moves, and that comes down really to discipline and planning. So before you enter any trade, you really want to define both your worst case scenario, that is your stop loss level, and then your target or exit strategy. So if an alarming headline drops in the middle of your trade, you're already going to know what to do. You're going to stick to your plan. You're going to let the market decide which stop is hit first, the stop loss or the profit target, right? You have a profit target on the upside, you have a stop loss on the downside, and that clarity is going to help prevent emotional knee-jerk reactions, which is what you're describing. Another thing that you might want to do, and maybe this is redundant for you, but another strategy is to avoid big events that spark volatility. Like if you're uncomfortable with risk, then you want to avoid, say, trading on a major earnings report day or a Federal Reserve announcement day. Those kinds of days I normally like to sit out. I often encourage folks just to, you don't have to trade every single day. And you really want, if you're really adverse to volatility, if it's not your preferred strategy, then what you can do is you can just lighten up your positions or stay on the sidelines until the dust settles on those kinds of days. So sometimes the best risk management strategy, as I often say, is simply not trading, just sitting on your hands. And another thing I like to do too is just keep your eye on that VIX, the volatility index. If the VIX is trending higher, it's a warning sign. If it's trending lower, sometimes it's not a warning sign. Sometimes it is a warning sign because the VIX tends to go up and down, up and down, up and down. So you really want to kind of get a little bit of a handle on that volatility index and those conditions. Where you see it rising, you can lower your position size or tighten up your risk profile until that volatility calms down. So in summary, you manage your volatility by sizing your trades appropriately. It all boils down to position sizing, placing those stops based on market conditions rather than just guessing, and maintaining, a good strategy. And I think by doing so, you're going to be better positioned to handle the volatility that comes your way. And one thing you can't do is get rid of volatility. So you just got to learn how to manage it. Okay, let's move on. We got another question here. We got several questions we got to get to. Next question is from Lee in London. He is a new silver member. And Lee says, Jerry, I have been going long for a while, but I want to explore short selling in a down market. What is the safest way to get started with shorting, and how do I handle the large risks that come with it? Okay, so Lee, short selling obviously is a powerful tool for many traders, especially in a down market where stocks or ETFs may be declining in value day after day. But you're absolutely right. It does carry additional risks that you absolutely must respect. And the first thing that I tell traders, and Lee, you're a new member here and you're a silver member, so I don't know a whole lot about your background, of course, but I can tell you that I rarely, if ever, short a stock. In fact, I don't really like to short stocks at all. Okay, it's just not my bag. So I think that it's best to avoid shorting stocks. The reason why is that when you think about a long position, if you buy, say, shares of Apple stock, and then it goes up, well, that's great. But if it goes down, well, it's capped at zero. I mean, the stock can't drop below nothing. I mean, so it's only going to go to zero. So you could lose all your money. But when you're shorting a stock, the short position has theoretically unlimited risks because a stock can keep rising and you're shorting it. So that's one of my least favorite strategies that I do not use at all. So the name of the game, if you're going to short sell, is incredibly strict risk management. But again, if you're new to trading at all, I would certainly urge you to consider starting with inverse ETFs. I wouldn't even really begin to use those until I fully understood the market and how to go long and how to succeed in long trading. But if you do, as you gain experience and you want to focus upon, trying to make money in down markets, the inverse ETF is really my preference. So for example, if you believe the S&P is about to decline, well, then you could buy an inverse S&P 500 ETF, right? And those are designed to go up when the market goes down. So that removes a lot of the complexities of shorting individual shares, and it doesn't require any kind of special margin requirement with your broker. So it's a much simpler introduction to profiting from a falling market. And then also, I think that another way to think about it is that you could also buy puts, that's options, and we have a whole entire options trading university here at followthemoney.com where I go into and explain how to actually use options to profit from a down market, specifically by buying put options. I think that can be a very powerful strategy for most people who want to get involved in profiting from a down market as well. Again, when you buy put options, you have a limited risk, unlike shorting stocks where the downside risk is unlimited. Let me give you one more tip here, Lee. Remember that shorting is something that you don't want to do during major market announcements. I mean, unless you're very, very sophisticated and have lots of experience, you really don't want to try to make a profit from a down market around, say, Federal Reserve decisions or those big earnings announcements, because it's just like flipping a coin. Down trends can snap back viciously if the news is unexpectedly positive, and vice versa. So managing risks, means that you just want to kind of steer clear of those kinds of setups that you're just not very experienced in. So in summary, I would start with inverse ETFs if you're brand new to shorting, and I wouldn't even really begin with those until I had a great grasp on trading long, going long. And I would also never trade an inverse ETF until I read the prospectus of that ETF, because some of these inverse ETFs, particularly the leveraged inverse ETFs, can be very complex, and you really got to know what you're trading. So again, I would urge you to not think in terms of shorting stocks, but looking for other strategies that might interest you, like buying put options or using inverse ETFs. And then, of course, maintaining a very rigorous risk management process. And done right, that could be a really potent arrow in your quiver as a swing trader. But just remember, it's going to take a lot of discipline and a very steady hand? Great question from Lee in London. Good luck to you, my friend. All right, let's get to another question. This one comes from Janet in Austin. Janet is a platinum member. She says, "Hey, Jerry, sometimes I'm torn between trading individual stocks versus sector ETFs, especially when I see a particular sector heating up. How do you decide whether to pick a specific stock or go with an ETF for a swing trade?" Now, again, this is a great question from Janet because it really shows the flexibility that swing traders have. You have a lot of different asset classes at your disposal. I mean, you could trade individual stocks, like you said, or ETFs. And when you drill down into the ETFs, you'll find that there are those sector ETFs like tech or energy. But also you can drill down into those sector ETFs and find the best performing stocks within those sectors. Or you could just simply trade the sector ETF, right? So the choice really comes down to risk tolerance, and I think that's really what's going to answer your question here. And also your expertise in analyzing individual companies, right? So one main advantage of trading an ETF is obvious, is that it offers that instant diversification, no single stock risk. So instead of putting all of your chips in one stock that might unexpectedly drop due to poor earnings or a negative company-specific news or some news event that affects the company, you're spreading your risk across many holdings in that sector with a sector ETF, and that can really smooth out the ride, even if one of the or two stocks within the sector really get hammered. It may not really materialize in the price of that sector ETF. And so too, analyzing a sector ETF can be a lot easier than trying to focus upon a single stock, even though that may sound counterintuitive. Individual stocks just come with a lot more risk, that single stock risk we talked about. Also, keep in mind though, the diversification you get with that ETF is kind of a double-edged sword. It means that that you have less risk, less downside likely, but also your potential upside or your potential returns are probably going to be more modest, right, than picking the best individual stock in that sector. So, if you can identify a top performing stock, maybe a tech stock that's beating its peers and consistently reporting strong earnings and sales, your gains could outpace the broader sector. But the flip side, of course, is that you pick the wrong stock and you might underperform the ETF or even lose money while the overall sector is still trending up. So to decide between the two, I think what you want to do is you want to start by looking at your time and research capacity. If you have limited time each week to analyze stocks in depth, then you're not going to have time to pore over the fundamentals and listen to earnings calls and read up on product pipelines, et cetera, et cetera. In that case, an ETF is probably the most efficient route for you. Obviously, you can still benefit from the sector's momentum without having to dive deep into an individual stock and, understand all of its ins and outs. On the other hand, if you have a knack for analyzing companies and you use tools like our profit tracker software, which I know you do, then you can really identify some really great opportunities, and you can filter those based upon earnings growth or relative strength or whatever metrics you want to, and then you can select the 1 to 2 top stocks as your swing trading candidates in that sector. So the way I do it personally is I'll often start by identifying a hot sector, right? We have our sector rankings here for all of our members. At Follow the Money, we track all 11 S&P 500 sectors. We rank them for position traders. We rank them for swing traders. We rank them for long-term investors. And so as a swing trader, what I'll do is I'll look at the sectors for swing traders and I'll say, what's the rankings? And so if I see, for example, that the, communications sector ETF is top ranked, or I see a sector that's rising in the rankings, well, then I'll dig into the top holdings of that ETF to see if there's any single name that stands out as a leader, stock that I like. And if I find a great performer with really solid fundamentals and a uptrending chart that maybe is pulled back or something, that's where I'll focus my swing trade, right? If I don't find a standout name or if I'm not comfortable, I'll just take the ETF itself. So there's really no wrong answer, right answer here. It's really about matching your strategy with your comfort level, right? And I wish you well in trading. Let's move on. We got another question here. Next question comes from Marcos in Miami. He's a silver member, been a silver member since 2021. Hey, Marcos. Marcos says, Jerry, my charts are starting to look like a Christmas tree with all of these indicators blinking at me. How do I avoid analysis paralysis and figure out which signals matter most for swing trading? That's a great question, and that's something that I think a lot of new swing traders fall prey to, is they just have so many different indicators on their chart called indicator overload. So I've been there. When I first got started, that's how I was too. It's easy to get carried away, all the different enticing technical indicators out there. You read a book or you watch a video and they say this indicator is great, and then you learn about this indicator and that indicator. Next thing you know, you got 10 indicators, on your chart, and you're just like you put it well, analysis paralysis, right? That's so true. For me, I think the fix is straightforward. Just simplify. Let's remember the core purpose of the indicator in the first place. These technical indicators are there to provide additional clues about what? About price action, right? That's really what we're after. So the best approach is to pick indicators that serve, I think, some distinct roles. So for swing trading, I often recommend a combination of trend indicators and momentum indicators, right? So for instance, you might want to use your moving averages like we've talked about with swing trading, especially like we've been talking about in this course, the specific moving averages we've been talking about. And that'll give you a sense for the overall trend. But then you can add, an RSI or a MACD to help gauge the momentum shifts. And I find both of them to be very powerful. If I had to choose between the two, I'd probably choose the RSI. And then if you overlay a few more indicators on there, you're probably going to end up with conflicting signals. And that's really what messes people up when it comes to indicators. The second thing you want to do is just pay attention to what's worked for you in the past, Marcos. Have you noticed that RSI really helps you identify overbought and oversold conditions? Well, maybe you want to focus more on that, or maybe you prefer to use the MACD crossovers to time your entries or exits. What you want to do is you want to focus on those indicators that actually improve your decision making, and then just ditch the rest. Just get rid of the ones that that you really aren't comfortable with. It's also important to keep your time frame in mind. So if you're trading off the daily chart or a 4-hour chart or a weekly chart, all that different indicators might be more or less effective depending on your time frame, right? Not always. Sometimes they transfer just fine. But I have noticed that some, not all, but some indicators can be great for short-term swings in a sideways market, while others might be better for spotting bigger momentum shifts in a trending environment. So it really depends on several things. So, maybe you could just perform a quick audit of your current setup. Just look at each indicator on your chart and say, what unique information does this provide? Am I already getting this from another indicator? Does it duplicate what I already have? Or does it complement it, hopefully? And then, have I used this indicator in my last few trades? Are you even using it? No, oftentimes people don't even use them. So you can just delete them, take them off of your chart. And so just remove that indicator. And by paring them down to just a few reliable tools, you're going to reduce your screen clutter. You're going to make quicker and more confident decisions, in my opinion. But ultimately, the indicators can kind of get in the way of trusting your price action and chart pattern recognition skills, right? This is really what we're talking about. Indicators are a secondary confirmation tool. The price action is always primary. We're talking about price, volume, and time, right? So we have candlestick formations and support and resistance zones and trend lines these are all reflections of market psychology, and indicators just help you interpret that psychology in different ways. So the solution to what you call a Christmas tree problem is to declutter, right? Choose a couple of indicators that each serve a distinct purpose, maybe one or two for trend confirmation, maybe one or two for momentum, and that's it, right? And in doing, you're going to cut through the noise. You'll avoid a lot of the conflicting signals, and I think you'll make good decisions with less hesitation. So great question, Marcos, and I'm sure that helped a lot of folks out there. All right, we got time for at least one more question. Maybe we can get two in. This next question comes to us from Larissa from Chicago. Larissa is a platinum member. She writes, as I grow my account, I've started taking more trades simultaneously. What's your rule of thumb for how many open positions a swing trader should hold at one time? I'm worried I might spread myself too thin. Now, this is another great question here from Larissa because it touches on both risk management and also your emotions, which is very, very important. There's really no one size fits all number in terms of how many trades you should take on at once. But I do have a few guidelines that I think can help you. First, you want to consider your total risk exposure. So let's say you have $50,000 in your trading account and you typically risk 1% per trade, as we've often taught. Well, that means you're risking $500 each time you open, a new position. So if you open 5 trades at once, well, now you have $2,500 in total risk on the table. And if each trade hits its stop loss, you're going to lose $2,500. And so you want to ask yourself, am I comfortable, losing that amount if the market turns against me? And if not, then you want to reduce the number of positions or lower your risk per trade. Second, think about the sector or, the sector risk or the correlation risk, we might call it, because if 4 of your 5 positions are all in the same sector, say like technology, and then the sector tanks, well, all of your trades are probably going to they're going to hit their stop losses, right? So diversification helps here. If you're going to take on multiple trades, being all in the same sector might not be a great idea. So you want to spread out your trades across different sectors. I would just try to avoid too much overlap. Thirdly, you might want to consider your capacity to monitor these open trades. Now, even though swing trading isn't nearly as time intensive as day trading, each position is going to require some checkups, and you're going to need to update your stop losses, and you're going to need to watch for earning dates so that you're not inadvertently holding a stock through an earnings date, or you're going to need to follow the news that, impacts that trade. So if you're scrambling just to keep track of it all, then that's a sign that you have too many irons in the fire. For me, I don't like to trade more than, 2 or 3 at a time. And I don't swing trade nearly as much as I used to, but even when I did a lot, 2 to 3 for me was enough. And then, you could gradually scale it up if you want to, if you become more comfortable. But most swing traders, prefer just to have a couple of trades open at a time. But it's all based upon your trading style, how quickly you want to, how quickly you can process new information and without getting overwhelmed. I mean, some people have different skill sets in that way. But also remember, trading is hard on you, and I don't know if you have a family or kids or, if you're married or anything, but, pay attention to your psychological well-being and all of it. So if you hold multiple positions, that can, stress you out a little bit, especially if the market gets volatile. And so, if you're feeling anxious or you're losing sleep over these trades, then dial back, obviously. Trust your gut on that. So, obviously manage your total risk. Avoid over-concentrating in a single sector if you're trading multiple stocks. But I think also reflect upon your stress levels. And I wouldn't want to be trading too many stocks at one time. That can be very stressful. I've done it before. I wouldn't want to do it again. So very good stuff. Very good question. I hope that helped. The next question comes from Timothy in Jacksonville, and this will have to be our last question. Timothy from Jacksonville. He's a gold member, became a gold member in 2022. Timothy says, I've done some day trading, but I'm transitioning to swing trading for a better work-life balance. Can you compare the two in terms of position sizing, overnight risk, and the mental approach? Any tips for making that switch smoothly? So Timothy's moving from a day trading to a swing trading strategy. And so, Timothy, I commend you for prioritizing work-life balance. I mean, that's huge to me. It's a very, very important thing. Day trading can obviously be exhilarating, but it is incredibly time-consuming. Most people don't realize it, and very mentally taxing. So I commend you on making that switch. I think swing trading is very powerful replacement for that. And I think, quite frankly, it's just a better solution for most people. Not everybody has the ability, to day trade, time-wise, mentally, all this kind of stuff. But swing trading, obviously offers kind of a middle ground between the very intense realm of day trading and then the longer haul approach to, say, buy and hold investing or, even position trading. So we'll just talk about a couple of the differences. You brought up position sizing. Well, as a day trader, you might have been used to taking larger positions with tight stops, right? And you're just looking for that tiny intraday move to make a profit. But with swing trading, you tend to hold those positions longer, of course, days or weeks. That can mean you have a wider stop loss, right? And smaller position sizes relative to your account. And the reason is that you have to account for those overnight gaps, right? So you can't go all in when you're going to be holding the stock overnight. And that, really means that you need to have more breathing room on each trade. So the way, again, I'll use the average true range again. The average true range of the ATR, I think that really helps here. Helps you gauge how much a stock tends to move on a daily basis. It guides you on where to place your stops, how big your position should be. So I would definitely be using that to guide my decisions on position sizing. Now, as far as overnight risk, you may recall day traders, you don't have to deal with that, right? You're out of your stocks by the end of the day. There's no overnight risk for you because you close out all the positions before the market closes. Swing traders are not so fortunate. They have to accept the potential for unexpected news or earnings releases that can move the stock significantly down, or other news that comes in. And so, the stock can gap down overnight. And to handle this, the way you got to do this is that you got to have a robust risk management strategy, right? So you're going to have to use stop losses and be prepared for stocks to gap down when you hold them overnight. That is something you didn't have to deal with as a day trader. That's one of the benefits of day trading for sure. And then, of course, you mentioned the mental approach. And let me just say this about that. Day trading, obviously is very, very intense. You got to make split-second decisions. You're constantly in front of your computer. And swing trading is just going to give you a lot more room to be strategic. You can analyze your charts at the end of the day. You can place your orders and set alerts. Let the trade develop over several days. And that means, less stress in many ways and more time to step away from the computer. But it does require a different kind of discipline because you're holding those positions longer. You really need to develop more patience to let the winner run, right? The old saying, let your winners run, cut your losers short. Well, that's a very true adage. And so you're just going to need to develop more patience as a swing trader and let that winner run. Also, you want to gradually shift your mindset to make that smooth transition as well. Timothy, trading fewer setups is smart as a swing trader. You don't need to, if you're a day trader, you might be trading several stocks in a day. Whereas a swing trader, you really want to focus more on those higher conviction trades and trade fewer of them. Instead of using the 1 or 5 minute charts as you do as a day trader, you're going to be using a daily or maybe a 4-hour chart instead. And of course, you're going to not have to worry about obsessively checking prices all day long, which again, a day trader does. Of course, he's right in front of his computer. Now, if you find it tough to let go of the rush that you get from day trading and you're trying to apply it in swing trading, that can also be problematic. So this is why it's so important that you got to remind yourself of your goal as a swing trader and not lose patience with trades as they're maybe going a little slower. It's just a different way of thinking. But overall, I think that swing trading is much more sustainable. It gives you larger gains, quite frankly, over time. And I think it also provides an improved quality of life. That may be arguable for some. There may be some situations where it's not. But I think in general, the swing trader just has more quality of life because he's able to work a job or do something else, or he or she can do that, versus the day trader who's kind of chained to the computer, let's be honest, right? So in short there, Timothy, position sizes might shrink as a swing trader, and stop losses are probably going to get a little bit bigger, right? So that's how we're going to kind of view this. So overnight risk is a thing. You're going to have a contingency for that. You're going to need to have strong risk management, as we've already talked about. So I think it's great. I think you can embrace this change. I think you're going to find that swing trading not only improves your trading results, but it's going to free up your time to enjoy life, maybe more so than you did as a day trader. So great questions from all of our members that came in. Great to have an opportunity to address those. That's a wrap for our Q&A session. What a great set of questions we had there. So to all of our members who took time to write in, I want to thank you for sharing your challenges and letting me offer you some guidance after many years of trading. If If you got follow-up questions as you've been listening to today's podcast, you might have a brand new question you want to ask, don't hesitate to drop us a line. You can always reach out to us at info@followthemoney.com. All right, well, up next, we're going to take a quick break, and we'll be right back with a quick market review and commentary. Stay tuned. We'll be right back. Hey there, traders. Jerry Robinson here. Before we jump into our market update, let me take a quick moment to introduce you to our brand new video course, Swing Trading Simplified, Charting Your Way to Profits. This is a new program that I have poured my heart into at the beginning of this year, and we're focusing on the exact steps that I have used over the years to achieve consistent swing trading results. Now, this is a 10-module course, and this is the most comprehensive course we have ever released on swing trading. Now, in this course, you're going to learn how to identify market trends and time your entries with precision. You're going to learn from me the essential indicators that you actually need to succeed without all the noise. You're going to find ways to pick the right stocks, ETFs, all based upon liquidity, volatility, and sector performance. The course is going to empower you with a rules-based system for managing risks so you'll know when to cut losses and when to let the winners run. And you're also going to learn the psychology of swing trading that'll ensure that you stay disciplined even when your emotions are tempted to run high. And here's the best part. As a followthemoney.com member, you're going to gain access to each of these videos in the course as we release them. We've already released the first 3 modules, and we're releasing a new one every single week for the next several weeks. It's like having a personal guide through every phase of swing trading, whether you're a complete beginner or whether you've been trading for years. So if you're ready to take a more structured approach to the markets, head over to followthemoney.com/join, become a member today, and get instant access to our ongoing Swing Trading Simplified course. We can't wait to welcome you aboard and help you level up your trading skills. I'll see you on the other side.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the planet. FollowTheMoney.com is where you can find us online. We're also on social media. The handle is FTM Daily. Twitter.com, I guess it's X.com now, /FTM Daily. Facebook.com /FTM Daily, and on and on and on. Great to have you back. Now, we just covered a lot of Q&A on swing trading, and we talked about our brand new swing trading course that we have out, and I'm really excited about that. Once that course is entirely done, we'll also make it available for sale in our store, but right now it's only being delivered to our members. So if you're eager to learn more about swing trading and you like what you heard today, I encourage you to head over and check out our website. Join our trading club and our investing club. Get access to all of our great resources and tools to empower your trading and investing and learn how to swing trade in 2025. So let's go ahead and move right into our very brief market update. And I want to begin with the S&P 500, which, by the way, closed this week at a fresh record high. Hard to believe, isn't it? It's simply incredible. We've been seeing a lot of volatility in the markets too lately, so it is perhaps somewhat surprising to see that the S&P has hit a record high. Currently trading as we speak, as I record this on Wednesday, the 19th of February, we're trading at about 6140 on the S&P 500. Still supported by a rising 200-day moving average and very solid volume across the board there. When you look at the percentage of stocks in the S&P 500, we call it market breadth, that are trading above their 200-day moving average, that number is about 63%, so it remains bullish. And there's plenty of upside potential there. Also, the NASDAQ 100 pushing towards a record high as well as it continues to power higher. We like to follow the Invesco NASDAQ 100 ETF QQQ, which gives us a lot of great visibility as to what's going on in that market in terms of volume and all. And it's very, very elevated here, but remains locked in a strong bullish channel, supported by a rising 200-day moving average and a rising 50-day moving average, which has acted as support as of late. We turn to gold. Gold also hitting a fresh record high just recently, as the dollar has begun to pull back a bit thanks to the expectation of interest rates, although not as many rates cuts as economists were expecting at the beginning of the year or even earlier or late last year. Now, if you look at the Fed futures market, you'll see that the expectations for a rate cut have been really diminished. 1 to 2 rate cuts at most is what's expected. We expect more. We expect at least 3 rate cuts in 2025. So we'll have to see how all that plays out. But if we're correct, that's going to mean more upside for gold and silver, more upside for Bitcoin and risk-on assets as the dollar begins to or continues to pull back from those recent highs. Gold, as I mentioned, sitting near a record high around $29.50 as of this recording. It's holding up very well right now. Gold is a little bit overbought here, of course. We have got up to some levels that indicate that we may be due for a little bit of consolidation before moving higher. But overall, we can see that gold is very well positioned for an uptrend. And gold miners, by the way, I just put out a note just the other day about the fact that gold mining costs, like the miner's cost, the production cost to get gold out of the ground and to produce it, is around $1,500 or less, and per ounce. And so that means there's a huge production margin for well-positioned gold mining companies. Our members can hop on to our website, followthemoney.com/SmartScore, and they can see all of our top-ranked gold mining stocks right now. We update those once a week based upon fundamentals. And the 2 top gold mining stocks on the list right now are both up nearly 30% year to date. I mean, that's so much more than the S&P is up. The S&P is up around 4 or 5% year to date. So these 2 gold miners are up nearly 30% year to date. So if you're interested in gold mining, silver mining, and then many other markets as well. China, for example, has been doing very well as it's been rising here in 2025. It's been a great start to the year for Chinese equities. We like to follow things like KWEB, the ETF KWEB, which is the China Internet ETF. That one was up more than 20% as of last Friday for the year. We look at something like the Russell 2000, the small caps. We see that they're still struggling, unlike the S&P, which has hit a new fresh record high. The NASDAQ 100 powering to near record highs, but the Russell 2000 still struggling below its high that was hit late last year. And so we do expect more upside for small caps, especially as it becomes evident that rates are declining. But as I mentioned, we are bullish on China. China continuing to power higher. In fact, we have quite a few earnings coming out of China, or at least Chinese firms that are listed here on U.S. stock exchanges. We have some Alibaba and Baidu and several reporting this month. And then we also want to take a look at silver. Silver has also been rallying since its low that it hit at the beginning of the year around $29 per ounce. Now it's back up about $33. It's still trading below its $35 level that it hit in late October of last year. We think that area will be breached. We think that gold will go above 3,000. Obviously, it's very close. We think that's going to be hit. We expect gold to go on to go a little higher this year. And then silver, we expect also to go past that former high of $35 that was hit in October. It's still trading well below its $50 high reached back in 2011. But silver, we think, has more upside. Oil has been a very choppy market, although it has been showing some near-term strength as of late. We could think of a few reasons for that geopolitically, but overall oil still kind of mired, though, in kind of a sideways grind. So oil prices, still struggling a bit in the current environment. And then let me also briefly talk about Bitcoin before we close out this very short market commentary. Bitcoin has been hovering around 95,000. Now we've seen Bitcoin in consolidation mode around that flat 50-day moving average. It hit a record high of around $110,000 just earlier this year. It's been pulling back from that level, as I mentioned, consolidating a really tight consolidation, sideways consolidation that's really been finding support between 91 and say, 100,000, just kind of bobbing back and forth in that range. We do think that Bitcoin is going to break out, and it's probably going to break out in a pretty sizable way, probably over the next month or two. We're going to see it move to the next level. And if you look at a chart of Bitcoin, you'll see that's what's been going on. If you go back to the very beginning of 2023, when we first called the 200-day moving average breakout, it was in January. It's been 2 years ago now. The price was about 20,000, and we called that. We mentioned the 200-day moving average breakout came out higher than normal volume, and then it's just been rising since that time. And what it does is it rises, and then it goes into these sideways consolidations. You may recall the one that we had last fall, fall of 2023, when it was hovering around 30,000 for months and months, and then it broke out and rallied up to 45,000, and then grinded sideways for a while. Then it broke out up to about 60,000. And then it just, from March of 24 all the way till about November of 24, we had a really long consolidation period. Okay. So, but then it rallied higher from about 60,000, 65,000, all the way up to 100,000. So we're seeing this. And if you feel like, if it feels, if you're having a little bit of impatience rising in you, just remember this is how this asset tends to work, especially. And right now we're in the last year of the 4-year cycle where we tend to get the biggest rally. And so patience, I think, is really going to pay off for those who can sit on their hands and wait for this trend to fully develop. We think there's much more upside ahead for Bitcoin, and also Ethereum. Ethereum is also trading near its lows for the last 6 months or so. It's trading at about 2,700 and trading below a declining 200-day moving average, which is generally bearish. However, we have a lot of high expectation for Ethereum by the end of the year. We expect it to do very, very well. So Ethereum is one that's on our watch list very closely. We own it. We've owned it for some time. And there are many other cryptos that we like to watch. We update our members on those each and every weekend through our Robinson report and also our charts page. We have tons of charts on our website, followthemoney.com/charts for all of our members. And by the way, speaking of Bitcoin, coming up in this May, 27th through the 29th, you may know that Bitcoin 2025, the big conference they hold every year, is going to be held in Las Vegas at the Venetian on the Vegas Strip. And I'm planning on heading to that conference, the Bitcoin 2025 conference. It is the premier Bitcoin conference that's held each year. And if you're planning on attending, I'd love to be able to meet you, shake your hand. In fact, we're going to be heading out there, my wife and I, and we're planning on meeting several people out there, but all obviously are members, Follow the Money members. We're going to have a special meeting just for you. So if you're a member out there listening to this and you plan on being at the Bitcoin conference, drop us an email. Go to followthemoney.com/contact and just shoot us an email or a message there and just say, hey, I'm going to be at the Bitcoin conference too, and I'd love to connect. And we'll reach back out to you with some information about how you can connect with us. We're going to try to make the most of this trip while we're out there. So we're going to plan a special meet and greet for Follow the Money members at a to-be-announced location on the Vegas Strip during the conference. So if you're going to be in town for the event, or maybe you live out in that area, just let us know. Send us an email so we can keep you in the loop on our plans. This is an exciting time to be a Bitcoin investor, and we're looking forward to heading down to Vegas to be a part of the Bitcoin 2025 conference this year. So again, if you're going to be there, be sure to reach out to us and let us know so we can try to connect while we're there. All right, friends. Well, on the other side of this break, we're going to come back with our concluding thoughts and a final word. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. It's been a great time today. I sure appreciate you being here with me along for the ride. And as always, like to leave you with a final word. This time, it's yours truly. Here's the quote. The difference between a professional and an amateur. The professional has rules and follows them. The amateur has feelings and obeys them. Now let's unpack that. When we talk about the professional in trading, we're not just talking about someone who trades for a living. We're talking about someone who approaches the market with rules and with a system, a set of very well-defined rules for entry, exit, position sizing, risk management. It's someone who recognizes that the market can be chaotic, but that discipline is what keeps you afloat. And so many traders, especially those who are just getting started, often lean too heavily on gut feelings, or they let fear and greed drive their decisions. They jump into trades because it feels right or everyone else is doing it, and then they exit too soon because of a momentary dip. So that's the amateur mindset, letting emotions dictate the trade. But a professional says, I will enter this trade only if it meets my specific criteria, and I won't risk any more than 1 or 2% of my account on any single position. And if the trade moves against me, I have a stop loss in place that will not be second guessed. You see, that's a rules-based approach. It might sound rigid, but it provides clarity in the heat of the moment. That's a clarity that amateurs often lack. You probably noticed in the Q&A session today on our broadcast that many of the questions boiled down to consistent themes like how do I pick the right time frame, or how do I manage volatility, or how do I avoid emotional decisions with too many indicators. The answer always loops back to a rules-based framework, a game plan that you set in advance so that you're not scrambling when the market throws a curveball. And believe me, it will. And that's exactly what we cover in our brand new Swing Trading Simplified course, by the way. Each module is designed to build or refine your rules, whether it's for finding high probability entries, managing your trades overnight, or avoiding analysis paralysis, as one of our listeners had put it. It's all about giving you the tools to trade like a pro rather than simply reacting like an amateur. And on that note, I want to thank you for tuning in today. We had a fantastic Q&A session. We covered a lot of market insights as well, and hopefully we left you with a deeper understanding of the mindset that it takes to succeed in swing trading. Be sure to check out our previous episodes of the podcast. If you want to revisit any of our previous episodes, you can find us, of course, on followthemoney.com or on iTunes or Google Podcasts, wherever you like to listen, or Spotify, wherever you like to listen to podcasts. And of course, if you're ready to take the next step, visit followthemoney.com/join to access the Swing Trading Simplified course and all of our other member benefits. By the way, if you found today's episode valuable, share it with a friend or a fellow trader. The more people that we can help demystify swing trading for, the better. And also, don't forget to leave a review or a comment. Let us know that you enjoyed the episode and what topics you'd like to hear in future episodes. Once again, thanks for listening today. And as always, remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll look forward to seeing you right here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.